Welcome to The Explainer. Today, we're basically playing financial detective. We're going to decode one of the most staggering, frankly unbelievable market performances we've seen lately, Seagate Technology, or STX. We're going to tear down their raw valuation and profitability metrics to figure out exactly what is going on under the hood. Whether you're actively tracking the tech sector or just fascinated by wild market momentum, this is a case study you absolutely do not want to miss.
All right, to kick things off, just let this number sink in. 189.36%. That is STX's year-to-date return. In a market where a 10% annual return is historically considered a total win, an eye-watering figure approaching 190% in a single year demands our attention. We have to uncover exactly what's driving it, and more importantly, if the underlying fundamentals actually support it. So here's our roadmap for today. 1. The Seagate explosion. 2. Paying the market premium. 3. Intrinsic value versus reality. 4. The profitability engine. 5. The check engine light. And finally, 6. The final verdict. Let's dive right in.
Section 1, the Seagate explosion, historical returns. Let's see just how high and how fast this stock has been flying.
The historical explosion in value here is, well, it's undeniable. And it's not just a recent spike. We're looking at a trailing 12-month return of 650%. But zoom out a bit and the numbers get even more surreal. A 3-year return of over 1,300% and a staggering 10-year return of almost 6,200%. I mean, if you had parked money in Seagate a decade ago, your portfolio would look vastly different today. But you know what they say, past performance isn't a promise of future results, which brings us to the actual price tag of this growth.
Moving on to Section 2. Paying the market premium, STX valuation. Because to buy STX today, you definitely aren't paying yesterday's prices.
Before we hit the specific STX numbers, let's just quickly ground ourselves. The price-to-earnings, or PE ratio, is kind of the ultimate indicator of how much the market expects and is paying for future growth. It literally tells us how many dollars investors are willing to shell out today just to get a single dollar of the company's current earnings. When this number gets high, it means expectations are sky high.
Now, the contrast here is absolutely wild. Seagate's current PE sits at a towering 75.40. Compare that to its normal 3-year average of just 15.67. That's a massive 381% jump. The market isn't just paying for a great company. They're paying a massively ballooned premium compared to what they historically thought was fair for the exact same business. And you know, this valuation expansion extends across the entire board. Price to sales has jumped up to 16.30, meaning people are paying $16 for every $1 of top-line revenue. The price to free cash flow ratio sitting at over 75, which is massively inflated compared to its historical baselines. Even the forward-looking PE is elevated at over 31. The market is basically pricing in absolute perfection right now.
All right, Section 3. Intrinsic value versus reality. The mathematical reality. What happens when we put away the market's enthusiasm and just look at the cold, hard cash flow math?
Here's where the dramatic tension really builds in today's explainer. On one side, we've got STX's last close price at a staggering $795.47. But on the other side, when we run a pure discounted cash flow fair value, which strictly measures the present value of the cash the business is actually expected to generate, it comes in at only $255.36. So the crucial point is summed up perfectly by this number, negative 211.51%. That is our margin of safety. Normally, as a value-conscious investor, you want a positive margin of safety, right? You want to buy $1 for 70 cents. But here, buyers at the current price are stepping into a deeply negative margin of safety. You're paying vastly more than what the baseline financial math says the cash flows are currently worth.
Which naturally begs a massive question. Section 4. The profitability engine. Why the market ignores the DCF. Why in the world is the market totally ignoring that fair value math and aggressively buying the stock anyway?
Well, here's the answer. The underlying business is operating like a hyper-efficient growth engine right now. Over the trailing 12 months, Seagate posted over 105% growth in earnings per share. Net income is up nearly 58%. And get this, free cash flow growth is up over 206%. The market sees a company rapidly accelerating the actual cash coming in the door, and they are more than willing to pay up for that trajectory.
Plus, the operational efficiency is just off the charts. Return on invested capital has skyrocketed to 58.22%. That means for every single dollar of capital invested in the business, they're generating an incredible return.
completely eclipsing their own 19% historical average. They're basically doing way more with way less and doing it better than they have in years.
Add in a return on equity of over 217%, and the picture becomes crystal clear. You can see exactly why enthusiastic investors are pouring money in. They aren't crazy. They're just betting that this high-octane profitability engine can sustain its momentum and eventually justify that giant premium price tag.
But hold on, Section 5, the check engine light, looking at dividends, debt, and health. Because every good financial detective knows you have to check the basement for hidden risks. We can't just look at the shiny exterior. And some warning lights definitely start to blink here. We've got a very heavy debt-to-equity ratio of 3.53, meaning the company relies heavily on borrowed money to fuel that incredible return on equity we were just marveling at. On top of that, the quick ratio, which is a strict measure of short-term liquidity, is sitting at 0.85, so below 1.0. That indicates we could see some potential short-term liquidity constraints if their massive growth suddenly hits a wall and bills come due.
Also, if you were hoping to get paid while you wait out any potential stock volatility, think again. Because the stock price has soared so dramatically, the dividend yield has shrunk down to a microscopic 0.37%. You're flying without the safety net of meaningful passive income here. This is entirely a capital appreciation play at this point. All right, Section 6, the final STX verdict, summarizing the clues. It's time to wrap up our investigation.
Let's pull all these clues together. The data tells a very cohesive, if a bit polarized, story. Seagate is a highly efficient, rapidly growing company generating tremendous cash flow. But the market has priced it at an absolute premium that completely ignores traditional intrinsic value. You've got record-breaking momentum and sky-high efficiency sitting right next to a deeply negative margin of safety and elevated debt risks. It's literally a high-stakes tug-of-war between operational excellence and valuation reality.
So, I leave you with this final thought for today's explainer to chew on. Does the sheer power of this profitability engine justify throwing the valuation textbook completely out the window? Or, by paying these massive premiums, are investors setting themselves up for a brutal correction waiting just around the corner? It's a fascinating dilemma, and exactly why we love digging into the numbers. Thanks for joining me today, and I'll catch you in the next explainer.